Okay, so this is a Silvergate Capital, um, small commercial bank in California, incorporated in Maryland. Here we'll just show what it's currently trading at now. It's having a down day. Market cap a little under 250 million. Executive offices in La Jolla, California. Before I jump to my kind of roughshod valuation on a deposit basis, let's go over some things about the business really quickly. Silvergate Capital is the holding company for Silvergate Bank, which is apparently the leading provider of innovative financial infrastructure solutions and services to people in the digital currency industry. So this is Bitcoin Bank. And I never thought I would actually say that phrase. I didn't think those two words could be combined that way, but 2020 is a year of just capriciousness. We believe we leverage our technology platform and our management team's expertise to develop solutions for many of the largest U.S. digital currency exchanges and investors around the globe. Their solutions are built on deep-rooted commitment and proprietary approach to regulatory compliance. I do like that they lead with that in an industry or in a growing niche in the financial industry that would require an incredible amount of trust and a leadership team to create a network for digital currency. They want to tell us right out the gate that you guys can trust us because they're apparently committed to the deep-rooted commitment and proprietary approach to regulatory compliance. Instrumental to their leadership position and growth strategy is the Silvergate Exchange Network, their proprietary virtually instantaneous payment network for people in the crypto industry, which serves as a platform for the development of additional products and services. And it has enabled them to focus on significantly growing their non-interest bearing deposit product for digital currency industry participants, which has provided the majority of their funding for the last 2 years. It's a distinctive advantage over most traditional financial institutions and allows us to generate revenue from a conservative portfolio of investments in cash, short-term securities, and loans that they believe attract solid risk-adjusted returns. And it's resulted in an increase in non-interest income that they believe will become a valuable source of additional revenue as they deploy fee-based solutions in connection with their digital currency initiative. Now, they recently IPO'd November 7th, 2019 at an offering of $12 a share, and they're still trading close to IPO price. They began exploring the digital currency industry in 2013, and they are recognized as an asset class. They developed the SEN in response to the rapid growth in the industry and challenges faced by investors. And their list of customers is somewhat surprising. Institutional investors, as they define it here on page 6, hedge funds, venture capital funds, private equity funds, family offices, traditional asset managers, digital currency exchanges, where digital currencies are bought and sold, and includes OTC trading desks, and other customers like companies and retail investors. Other customers are a growing amount of the customer base from 142 to 235 customers from 2018 to 2019, respectively. But they are not that much of the deposit base. They haven't grown that much in terms of deposits. So 274 million to 286 million in deposits, 2018 to 2019, respectively. Institutional investors as customers have grown substantially. 363 customers to 509 customers, 2018 to 2019, respectively, but are not the largest number of deposits. Digital currency exchanges are at almost $500 million, 527 million to be precise. They developed the exchange network to be a way to move US dollars between SEN participants whenever you want. Now, the core function of it is to allow people to transfer it, and this is in their own terms, allows them to make transfers of US dollars from their SEN account at the bank to the bank account of another SEN participant with which a counterparty relationship has been established. It does it on a virtually instantaneous basis compared to other banks, which can take from several hours to several days to complete transactions and transfers. Their proprietary cloud-based application programming interface, combined with online banking tools, allows customers to effectively control their fiat currency, transact through the SEN, and automate their interactions with their tech platform. The number of SEN transactions underwent a 485.4% increase from 2018 to 2019, from 7.8 million to 46.06 million, respectively. And then the volume of SEN transfers has also seen an almost 300% increase from 8.2 million to 32.7 million, 2018 to 2019, respectively. So their business model has them taking the digital currencies and then throwing them into their non-interest bearing deposit base. And allows them to manage interest earning assets conservatively, and they've transitioned from primarily deploying their funding into loans to deploying funds into assets such as earning interest earning deposits in other banks and securities that generate attractive risk adjusted returns. They segment their deposits based on volatility. Their interest earning deposits in other banks totaled 132 million, and the average yield for said deposits was 2.24%. Their portfolio of securities available for sale totaled 897.8 million from December 31st, an increase of 151.3% from December 31st, 2018, a portfolio primarily made up of adjustable rate MBSs, collateralized mortgage obligations, and pools of government-sponsored student loans. This one was actually pretty surprising to see, government-sponsored student loans. I was not expecting that. They selectively deploy their funding on the bottom of page 7 into specialty lending businesses, including commercial and residential real estate, mortgage warehousing, correspondent lending, commercial business lending, bread and butter banking. Nothing necessarily too surprising. So I'm going to jump down and look for this statement in the public accounting firm. So I just wanted to run through kind of the overall business shell of what they do. It's Bitcoin Bank, and they take the digital currency deposits and throw them into their non-interest bearing deposit section, and then take that and then move it over to generate attractive risk adjusted returns. The auditor is Crow in Atlanta, which is odd for a company that's located in California to pick, but okay, I don't know if I should be worried about that or not. They signed off on it saying in all material respects. I don't know how much I should trust the auditor report considering Luckin and Wirecard happened in 2020, but I will take that for what it is. Now I'm going to use the deposits here. And what I'm going to do is I'm going to try to value this on a deposit basis. So I'm going to take the average. I'm going to take a deposit for share first. So I'm going to look at total deposits, and these numbers are in thousands. I'm going to take the total deposits, 1,814,654. I'm going to go down to the diluted shares outstanding. All right, $98.70 per share. I have my notes in front of me too to make sure that I don't mess up the numbers as well. So after that, I'm going to go back to the balance sheet, and I'm going to look for gross loans. So they split their loans up here. Loans held for sale, lower cost or fair value. Loans held for investment. I'm going to add these two together. And I end up getting, just to keep the math here, $1,040,544,000. I'm going to do the same thing over here, and I end up getting, I'm just going to punch this all in. I end up getting for average loans for 2018, $943,417,000. I'm going to take the average of that. So you get average loans as $991,780,500. Next, you're going to go to loans and fee income on the income statement. It's going to be the first line here on page 77 if you want to follow me along. So you're going to take 991,780,500 divided by 51,445,000. And you get I did that backwards. You end up getting, I did the math backwards, you're actually supposed to take loan and fee income divided by your average loans. So once again, to correct that mistake, loans, including fees, that's going to be your numerator, and then your average loans are going to be your denominator. So you're going to get 5.18%. Now write that down. You're going to get 5.18%. This is what they can earn on their loans. Now, what I'm using as my benchmark here is the AAA corporate bond rate. So I'm going to type that in. The AAA corporate rate effective yield is 1.57% as of today. I'm going to use that as the long-term market price of money. I'm not going to use the Treasury bond rate right now. One, it's historically low. And two, people buying Treasury bonds aren't buying them for the same reasons that I would be buying it. People usually buying Treasury bonds are doing it for safety of principal and trying to use it basically as a high safety savings account. I don't want to use it that way. And I wouldn't be buying a Treasury bond for the same reasons that someone would be selling me a Treasury bond. So I'm going to use the AAA corporate bond yield, 1.57%. I'm going to use that as my benchmark. I want to know how much money they make in relation to that benchmark. So I have that written down in front of me. Now I'm going to go and keep that 5.18% in your head. That's what they can earn on their loans. This is a conservative estimate, by the way. I'm not backing out gain or loss on sale of securities. I'm not pulling out goodwill. I'm not going to do any of that. This is going to be as conservative as I can make it because I admit that I am still learning and I need to learn how to do this properly. I'm going to go back to the balance sheet and look for average deposits or get the average deposits. So I'm going to end up taking 1.81 million. Well, yeah. I have to remember that these are all in thousands. Get the average deposits. All right, so you end up getting $1,798,829,500 of average deposits for 2019. You're going to go to the income statement. Go to interest expense for deposits, $7,713,000. So what I'm going to do is I'm going to divide the interest expense, what I just said, $7,713,000 divided by average deposits, multiply it by 100. That is 0.42%. The average cost that they paid on their deposits. Just to keep the money in-house, they had to pay 0.42%. Now I'm going to stay here on the income statement. Once again, this is still page 77. We're going to look to net non-interest expenses. Got 52,478 minus, I'm going to pull back out non-interest income so I can get net non-interest expenses. 36274. Excuse me, 36724. Got to look at my notes. Net non-interest expenses. You're going to divide average deposits. You're going to divide that by average deposits. Once again, 1,798,829,000. Multiply it by 100 to get a proper percentage. You get 2.04%. Now you're going to take that 2.04 and then add back what we said was the amount that they paid on their deposits in 2019, 2.04 plus 0.42. You get a cost of funding for 2.46%, the rate that they borrow at. Now, this is not lower than the current AAA corporate bond rate, which we said was 1.57%. You get 1.57% from the long-term market price of money, and then it's a cost of funding of 2.46%. This is the rate that they borrow at. So this is a problem because they can't lend lower than 1.57% and then give loans out at 1.57% or higher. You would need this to be lower for it to be a bank that you might want to make an investment in. So what I'm going to do is get the economic value margin of their deposits, 1.57 minus 2.46. And it's going to end up being negative 0.89%, which is not good, but they're still nascent in their life cycle as a bank. So I figured that they're going to straighten this out. I'll work that out in the next video and try to value the bank based off of a free cash flow to equity model. So I'm going to take negative 0.89 and try to be precise here. And I'm going to go back to the deposit per share that I got, which I said was $98.70. I'm going to do that. Then I'm going to multiply it by 10, which is like giving a number to an after-tax earnings power of 15 for a PE ratio. So I'm going to slap a PE ratio of 10 on there. And I end up getting a dollar cost of $8.78. So if this is the rough intrinsic value of Silvergate Bank, then that means they're trading well above what they should be. Now, do I believe that they're going to grow larger and they're able to make more profit off of the fees that they want to make off of their digital currency network and continued lending in the digital currency markets? I think so, but I'm going to have to return to that in another video. Once again, we got a conservative intrinsic value based on deposits at negative $8. Well, let me do it like that. $8.78 a share for Silvergate Capital. All right.